Okay, we're going to add the final section to our investment spreadsheet. Just to summarize where we're at, we have added the income and expense section, and then to that the loan information, which appears down in this section. And then the next step was to add the tax analysis. That was done in this section. So, finally, we need to add the ratio analysis, which will help guide the investor through the process of making a decision on whether to invest. So, what we did first was calculate the cash invested, $746,589, and that calculation appears below. I'll show you that, but we've talked about that quite a bit. We purchased it for $1,400,000, had $21,000 in transaction costs, and the loan amount was $674,410. Let's go back up. Next, I calculated the cash-on-cash return each year. To do that, I took the cash flow after taxes, $19,185, and divided it by the cash investment of $746,589. That gives a cash-on-cash return of 2.57%. The next calculation is easy in one sense, however its meaning is not easily understood. This is the present value of the after-tax cash flow. If the investor needs to achieve a 15% return on their investment, then the projected cash flows need to be discounted at 15%. Let's work through the calculations. It is done using the net present value formula and discounting the projected cash flows of years 1 through 5. The result is $482,741. So what does that mean? Well, I'm considering investing $746,589, and to achieve a 15% return, I should not invest more than $482,741. So the net present value, the difference between the $746,589 and the value of the discounted cash flows of $482,741, is the amount I overpaid. $263,849. That's what that number means. So at this point, the investor needs to make a decision. Should she ask for a price reduction or pass on the deal? We're going to talk much more about that later on. And if you want to see what your return would be if you could negotiate a price reduction, the internal rate of return is 5%. All right. So what happens then if I reduce my cash invested by $263,000? Let's do that real quick. Minus $263,849. What's going to happen? The net present value is zero. I'm paying exactly what I would need to pay to earn a 15% return. And then the internal rate of return is 15%. Okay, you see how that works? Now, I'm going to set this back to what it was. Now, the next ratio is the first-year operating ratio. That is just taking the operating expenses of the property and dividing it by the effective gross income, and that's 40.07%. 40% of the income that came in went to pay the operating expenses. It's this next ratio that's a little bit concerning. In fact, it's a lot concerning. If you took the operating expenses and added the debt service to that and divided that number by the effective gross income, the break-even ratio is 88%. You would need to spend 88% of the effective gross income each year to break even. That doesn't leave much for the investor. Next, loan to value. We've talked about that a lot. The way it's calculated is to divide the loan amount by the purchase price, $1,400,000. That's 48.17%. It's not bad. I'll leave it there for now. The equity dividend rate. That is the cash flow before taxes divided by the equity invested, the $746,589. And so that number is 1.79%. But the cash on cash is 2.57%. How did that happen? Well, because that's calculated after taxes, and there was a tax benefit in the first year. We'll talk more about that. So in the first year, 1.79%. Overall cap rate. Cap rate is the cap rate. Net operating income divided by the purchase price in year one. So that was 4.78%. If you want to talk about that same calculation in subsequent years, that's referred to as the return on assets. And that's what I did here, 4.78%. Okay, and I'll leave it there. We'll come back and talk about that more. Next, the mortgage constant is 7.94%. As we discussed in our leverage section, if the mortgage constant exceeds the return on the assets, any increase in the loan amount will reduce the return to the investors. Okay. Well, I think that's everything in this section. I have another lecture that follows this. The calculations of the internal rate of return, net present value, and present value. How are they calculated, and how are they related? Please look for that in the next section. Let's move on.